you to the opening playbook. The opening playbook is a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. We offer market insights, that's timely analysis of what's moving the markets right now, trading education to help build real skills beyond surface level tips and tricks, and live trade ideas, which are real-time recommendations that you can act on immediately. Opening Playbook is a free daily live webinar. And the stars of our show are Nathan and Graham. Nathan has over a decade of experience trading Forex stocks and beyond. He's worked with dozens of leading global experts on strategy development. He's obsessed with math and systematic edges in trading. He's the creator of the Income Machine, overnight options, and more. He's a husband, a dad of 7, and the publisher here at the pub. Graham Lindman is also an options expert with over a decade of market experience. He studied technical analysis under 2 of the top minds in finance. He developed his infamous wrap order option trades for cost-effective entries and has created lightning trades, moonshot alerts, NVIDIA Elite, Apex Indicator, and Newton. A lot of people in the stock market education industry will tell you that trading is easy if you just know their quote-unquote secrets. Well, that's not us. We'll tell you the hard truth, which is that trading is complex and takes time to learn. However, we can make the learning process much easier. The opening playbook exists because a lot of traders have trouble succeeding because they believe many of the myths out there about the market and trading. We'll dispel those myths and equip you to become a better, more mature trader, giving you the opportunity to be more successful, whether that means using our systems, tools, and strategies, or just trading on your own. Remember, our goal is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding of the markets. It's important to always remember that you should never trade with money that you can't afford to lose. Nobody likes losing, but there's a difference between losing some of your investment portfolio and losing the rent or grocery money. So please remember to keep your risks in check and never trade with money that you can't afford to lose. And let's be ultra clear, any type of trading will involve some losses. It's inevitable. Controlling your risk will keep you in the game, and we can help you learn structures and strategies to do just that. Our promise to you is that we'll be honest and transparent with you about what works and what doesn't, what you should make your own decisions about, and what rules we think you should always follow. A few simple rules to start you off with are stay calm, as in trying to trade without emotion involved. It's very difficult. Go at your own pace. It's not a race. You don't need to keep up with us or other traders. Go at your own pace and ask questions freely. We really do want to answer your questions and help you as much as we can. To help you get started, we'd like to offer you some free information. Answer a few quick questions by clicking the link in the banner that I'm about to pop up at the top of the screen. There you go. And for doing that, we'll be able to give you a couple of things. We'll be able to customize the content in Opening Playbook based on your feedback to provide better content suited for you. And we'll give you a free options cheat sheet, which is a digital, easy to understand options guide that looks something like this, but will be a lot less blurry when you get the actual thing. Now, I just want to take a couple of minutes for those that are new to Opening Playbook to talk about this platform that we're using. Obviously, it's a little different from a typical Zoom platform, and I want to help you get the most out of these webinars by showing you how to use this platform a little bit. You can click on the hamburger icon. That's what we call those 3 horizontal lines in the top left corner of the screen to reduce the size of that green column on the left. We don't need the green column, so the smaller it is, the more room we have for other things. In the bottom left corner of the display area, you'll see a little speaker icon. That is the mute and unmute button. If you do need to mute us for something, you can click that. Or if you find that you've suddenly lost audio, but the video is still going, you may have accidentally clicked or tapped on that speaker icon. So check that if you lose sound. In the bottom right corner, you'll see two different icons, or you may not see both or either of them. It depends on which platform you're running this software on. So if you see that double arrow there, that can be used to go full screen with the presentation area. It will hide everything else and show you maximum size on the display. The square inside of a square is the picture in a picture. That will actually pop the video out into a small floating window so that you can do other things in the background, like go to your broker platform or another website. Now, as I said, you may see one, both, or neither of these icons depending upon what device you're on and which web browser you're using. You should all have this icon below the video presentation. It's a little monitor icon, and this will be good, I think, for most people to use. This will give you maximum size on the presentation area without hiding the chat. So you can still stay in communication with the chat, but see the presentation as big as possible. And next to that is this low latency slider. If you're having any performance issues where it's like buffering or kind of locking up a little bit with the audio or the video cutting out, click on that low latency slider. That will cause a few seconds delay in you getting the feed, but should smooth it out for you. And a few seconds probably won't make a difference. The whole column on the right is dedicated to communication with the chat. The big area in the middle vertically is where you'll see your chats as well as everybody else's. Keep in mind that this is a group chat. Whatever you type in this box at the bottom, it will go in that column and everybody will see it. So you would just type your message at the bottom and either hit enter on your keyboard or tap on that little green arrow to submit your message, and it will post in the group chat. However, there's a toolbar at the top which gives you some other options. The first one, which is the right arrow, although it's all the way on the left, will collapse the chat area. I don't recommend that because there's a lot of important things that happen in the chat. You probably want to keep the chat open. The megaphone or bullhorn icon will bring you to the announcements tab. The announcements will have any live trades that we've taken during the session, as well as a static set of helpful links. If you've never seen the helpful links, I highly recommend you check that out. And this double speech bubble icon is for private messaging. This is where you can send messages that the whole group will not see. When you click on that, you'll be able to private message any of the hosts. And if we send you a private message, you'll see a little red dot up in this green toolbar to let you know to flip over to this tab. So look for that little red dot up there occasionally to see if you have a private message waiting for you. And then if you want to get back to the group chat from either of these other tabs, you just click on the speech bubble with the 3 dots in it. Last but not least, we have this diagonal arrow icon. This will pop the chat out into its own floating window. So if you're using multiple monitors, let's say, and you want to go full screen on the presentation in one monitor, you can pop the chat out and have it on a different monitor. And that's it. So once again, welcome to Opening Playbook. Please don't forget to complete that survey. And even if you're not brand new, the survey is relatively new. So if you've never filled out the survey, please, you don't need to be brand new to Opening Playbook to do it. We're happy to give you that cheat sheet as well. Even if you've been here for a year, if you haven't filled out the new visitor form, click on that link in the banner above to complete that survey, and we'd be happy to give you that options cheat sheet as well. So now we're going to play the theme song, and then we're going to get into our regular show right at the top of the hour.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh. Charts are lighting up the morning sky. They spot the trends with a hawk side. Options in place in a locked display. They spot the trends with the hawk side. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh. Step by step they break it down. No confusion, no spinning around. With every trade they set the tone. Making big calls from their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Well, good morning, everyone. Welcome to the opening playbook. Getting started here just a minute or two early, just because got through the pre-show a little early and ran the theme song a little early, and so we're getting started a little early, but that's okay. Good morning to everyone. Hello in the chat. Brad, Henry, hopefully those links get you what you need that you were looking for in the chat there. Good morning to Ed and let's see, Gene, Bob, Twitch, Maggie, Robbie, Roger, Paladin, Susan. Crazy weather in Denver. Yeah, I was hearing about that from Ezra over at WealthPin yesterday. He's over there in Colorado as well. William, good morning. David B, Clem, Jimmy. Yeah, different weather all over. Kind of crazy these days. Looks like we have a nice little pop in the market this morning. I think it's getting off to a nice little start if you're bullish on the S&P there. We'll see what Nathan and Graham have to say about things in just a minute here. Snow in Kansas City. Yeah, Jono, we're here in Jax, Florida also. That's where our main office is, so we have that same weather. Actually, late yesterday we were busy doing a webinar for Alex Reed, and I thought I heard sleet hitting the window there. It was just really hard rain. I knew it wasn't sleet because it was 70 degrees out, but it was really hard rain, or I should say rain with really hard winds slapping it against the building so hard that it sounded like it was sleet. But yeah, just rain obviously at 70 degrees, but pretty strong weather over the last 24 hours. All right. Good morning, Nathan.
Good morning. Happy Monday, everyone.
Happy Monday.
Hope everyone is doing well. Gonna find out here if we've got any kind of real turnaround in the market starting or just a flash in the pan.
Right.
I'll give you my point of view here in a moment. So just to quickly show you where we are here. This is on the SPY. So this is that same box we've had, drawn for forever now. Obviously got kind of rolling down below that. Now we're making a rip back up toward the bottom of it. So to me, until kind of told otherwise, oh, that's my Thinkorswim chat ringing at me. Until otherwise confirmed, I think this looks like a retest and probably still wants to make a move down toward the 200 moving average, which we didn't quite hit. We did hit it on the futures here. I guess actually here is where we hit it on the futures March 9th, but never actually came down at the SPY and touched. So right now, I think odds on favorite are that we have a little bit of a touch here, maybe a day or two, or maybe even just this morning, and then start moving back down. One of the things that I think happening at least so far today that's not completely convincing of hey, we're just right back in war is good news coming to an end, everything's great, is that actually the VIX, while it's down, is not totally melting. It's down like 10%. And right here at the bottom, when we had popped up somewhere in this March 8th, March 9th range, the VIX was like 20 or 20 and a half, and now it's 24. So I think, we're not seeing the actual belief that this is a reversal in the market, in my opinion. We're seeing just hey, it's positive, VIX comes down. We'll see what happens from here. That said, let me flip to my...
Do you want to talk for 2 seconds about what you mean when you're comparing the futures versus the S&P?
Yes, I will. But first, let's go ahead and close our closing playbook SPY trade. Should be able to get 110, 115% on that puppy for any of you guys who took it. Tip of the cap to Graham, who shot over that messaging there about the SPY and the 4 days in a row, specifically on Fridays, and specifically that it makes a pretty big move on average. So we took a well out of the money bullish position if you guys were on closing playbook on Friday. And you can hold it and go for like the 185% or so. But I'm going to close it right now.
This was the falling knife trade, right?
Yeah, that's the falling knife. See if we can get filled for that.
That's awesome. I'm getting an update for you guys on that as well.
All right. Well, I'll crawl this down while if you want to take it over and
Sure.
show your update.
So hopefully you guys were able to, let's see.
I'm trying at 86 cents, by the way, right now, folks.
Let me know, guys, if you were able to see a version at least of this. I'm trying to get this thing to resize. A version of this in either closing playbook or my Telegram on Friday. Give me a yes or a no in the chat. I got like 100 thumbs up. So I know like at least 100 people saw it. And then you covered in.
Oh, and we had 400 people on closing playbook. So yeah, we should say a lot of people who saw it.
Awesome. Well, this looks like an ugly spreadsheet. Lots of numbers, lots of colors. We'll go ahead and focus over here for now. So we've done fade trade training in here. Hopefully you guys have attended that. If not, the recording should be in the opening playbook members area. It's a great one to review. Basically, we said, hey, if we ever get the markets down 3 days in a row, make a mental note that there's a good chance it'll pop. If we get 4 days in a row where the markets are red, there's the odds just get even better. So what I did was on Friday, I noticed, hey, we've been down 4 days in a row. That's a pretty awesome trade. So I have this whole spreadsheet here that I'm not going to bore you through, taking you through it, but I ran some different formulas basically to say, hey, every single time over the last 30 years, when the S&P 500 falls 4 days in a row, what happens the following day? So here's all days, 282 times it's happened over the last 32 years. Win rate almost 65%. Can't complain about that. Average return of winners and losers 0.4, which doesn't sound like a ton, but if you consider that the average daily return is 0.04, that's 10 times the average profit potential on a day like Friday. Then I ran the same stat here for Friday, specifically same exact setup, but hey, let's just look at Fridays only. Win rate fell a little bit, but the average return actually increased. So the profit factor went up. You can see here, profit factor went up. The multiplier went up. So Friday was even more profitable. So I shot into Telegram. I shot a couple tickers that I was buying with my account, up $8,400, $8,500 over the weekend on it. So pretty pumped about that. Now there are a couple things to note. First thing, we look down here. This is going to show us the same stat. This is holding all day. So if you hold all the way through the end of day Monday, this is what it historically looks like. Here's what it looks like if you sell at the open, which obviously we're 30 minutes past the open, but there's something important to note here. So if you hold all day, here's numbers. If you sold it at the 9:30 opening bell this morning, here are the numbers. Look at this. The average pop on a Friday 4 day down setup is 0.91% at the open. Does anyone know the exact number we opened at today? I think it was 0.95%.
Yeah, something right in that range.
Something right there in that range. So super cool to see it playing out to a T exact, the exact same way again. Now there is one thing that I want to note here. Look at this. This is selling at the open, 0.91% gain. This is holding all day, 1.7%. So we have had an amazing open. We've gone about what, the 0.25%, 0.35% higher. My point is here, we average on the day, 4 days down on a Friday. We pop at the open. What does the market typically do intraday? It typically gains on average another 0.8% intraday. So given today's price action, that would put us about 1.7% by end of day. We're at 1.25 right now. So what I'm saying is that it looks like there still may be more room to run here intraday. So I'm going to hang on to my positions right now and let it ride. Does that make sense to everyone before I get to the next point?
Makes sense, and we got 2 people who saw it in the chat, so at least
Okay.
2 people saw the chart, which is amazing. I don't know, maybe folks are sleepy on Monday. You guys are here, right? You can hear us. Yes, hello, everyone's here, right? A beautiful big day in the market.
Day. It's a rainy day in Jacksonville, so I can't blame you guys if you want to just kind of cozy up, take a nap. It kind of feels like that weather, but awesome start to the week for the market. So, anyways, some people are asking, can we still take a trade? In my opinion, you can. You can, because this is why. We average a 0.8% increase intraday. We are currently up, I'm going to call it 0.3%. So there's still a 0.5% meat on the bone, historically speaking, from now until 3 p.m. Now, with that said, let's then turn our eyes over here. This is just basically saying, okay, we've already had the 4-day setup. We've already made our money. Everything's going good. How does it, what typically happens the next day? So what I did here was I pulled it for all days. Every time we get a 4 days down, what happens? This is our 5th day. We're up. What happens the next day, regardless of how today went? On average, 59% win rate. Average return still above average. Still above the historical average. Not that juicy. This is where I want you to look though. This says, all right, we had 4 days down. We bought the dip. We bought the falling knife. We faded the markets to the upside. It went up. Markets made money, like we're seeing so far today. What happens the next day? Well, this tells us that historically speaking, of the 182 times, so we're in number 183 now, but of the 182 times, the markets only went higher the next day about half the time. On average, the markets actually lost money the next day. So with this data in mind, I will be looking to book my profits today. Not saying we can't go higher tomorrow. It's a 50-50 shot, right? I just don't want to have my whole account on the line for a 50-50 shot where the average return is pretty much flat. So hopefully that makes sense for you guys.
Yeah, love it. Love some good data. I did book mine for about 85 cents. Maybe I booked it before I got to see the rest of Graham's data, and I should have held on a little bit longer. But I got about 120% on our falling knife trade, so I will take it. Awesome. For those of you asking, that was a closing playbook Friday trade that we did right around 345 with a debit spread, but then Graham also posted some ideas directly in his Telegram. So whether you were in closing playbook or Graham's Telegram, hopefully you got a little bit of the action on the bounce. And where we go from here, I think Graham said it well. It's a coin flip, I think. Not to continue to take the coin flip view, but I think that's kind of the reality of a very headline-driven market, especially in the zone that we're in right now. So what I'm going to do is I'm just going to walk you through quickly as I try to do where we stand right now, and then we're going to get into a little bit of training. The training that, yep, that is exactly it. Thank you, Mitch. The training that I'm doing today, I call what traders should know, things traders should know. And it's basically just 8 or 10 things that I think are really important for people to know, especially if you are, here in Opening Playbook and you're following the way that we trade and you want to have a better understanding of the different structures and elements that we trade. So if you guys are newer, just give me a yes in the chat if you're, say, I don't know, 2 weeks or less been around Opening Playbook or our community. Give me a quick yes in the chat if you're a little bit on the newer side. If you are in that camp, then There's some terminology and things like that you're probably catching up on. There's some, some trade structures and things like that. But there's also some like conceptual ideas, like why we even think about things in a certain way. And I'm going to try to give you some insight into both the practical and the conceptual when we go through that. So it's a good one, in my opinion, especially if you are a little bit newer. Just take notes, take some mental notes. Maybe it won't all make sense today right out of the gate, but it'll be something that makes more sense as you go along. So we'll shift gears into that in just a couple minutes. And then, by the way, I have my 11 a.m. session, which is going to be another kind of unique thing, because in that session, I'm actually going to give you 3 relatively lower price stocks that I think have some really nice long-term potential, which if you guys follow me is not usually what I'm focused on. Usually I'm talking about mathematical edges and systematic stuff and mechanical strategies. But I took a little bit of a detour, and we'll go through at 11 a.m. to put some research together for some long-term stocks, especially because we are in a little bit of a beat down market, not extreme, but 5% or so. And if you guys follow Graham and I, you know that, as soon as we start getting a little bit of a correction, we start thinking, okay, what can we buy? What's on discount? What has potential? We're not quite to, the all-star portfolio. What did we call that last time? Dream portfolio. Is that what we called it? Yeah, we're not quite there. Probably need a 10% correction to get there, but we're maybe working our way down. So anyway, here's where we find ourselves today. SPY obviously having a beautiful day. Q's having a bigger day, and small caps up the most. Pretty much the normal risk on order that you would think that you should see in the market on a big up day, especially with Bitcoin all the way up at 4.5%. By the way, I did close my Bitcoin, or not my Bitcoin, but my IBIT trade, the one that I bought a little over 100 grand a couple weeks ago on IBIT. I did go ahead and close out today. I think it still might hit 79, 80K like we talked about initially, but I had a pretty nice trade on that and went ahead and booked it with the uncertainty that we have right now. And so this is the overall view. Now, of course, the sector view today is outrageously positive because we have that buy the dip environment that we just talked about, where pretty much everything is up across the board, leading to that SPY and RSP and Qs all being so positive. The big ones are technology and discretionary, because those, of course, have been red, kind of been leading us to the downside a bit, and we're seeing them. And then actually seeing financials. I mean, financials have just got the heck beat out of it for a while here. Show some life would be interesting. Now, again, we're 40 minutes into one market session, so let's not get carried away with what we expect to happen based on what we see here. But something to keep an eye on, because even on some of these more positive days, we have seen financials and several other of the sectors not really get going. We've seen, technology be green, maybe industrials and energy, but several other sectors still lagging behind. It is nice to see that participation across the board. Now, if we go back and just look at the last 3 sessions, you're going to get a much more. Oh, wait, hold on. Let me see if I can. Oh, I didn't load it. Okay, I'll load it later and show you. But you'll see if you go to the last 3 sessions, pretty much everything is red, and then you have energy being green. Notice today we have almost the exact flip that we had on Friday. We talked about literally full participation to the downside. 90% of the top 100 market cap stocks were red. Well, now we're just flipping that back on its head with 90% of the top 100 market cap stocks being green. We're being led by what I think has been the best stock out there for the last couple of months. That's Micron. If you guys haven't seen Micron, it's been an absolute juggernaut here since September. It's up about 300% and continues to lead on most of these risk on days. So Micron way up there. GEV, a stock that we love to trade, is up there. Meta, Tesla, most of the Mag 7 showing up. At the very bottom, it's just a mix of some defensive stocks, and they're really not, other than T-Mobile, they're really not even down. Notice that in the top 100 market cap right now, we have 2 stocks that are down more than 1%. In the top 100, only 2 stocks down more than 1%. Meanwhile, look at all the stocks that are up over 1%. It's a myriad of stocks. So this is a very, very healthy risk on pop. But keep in mind, you can get some pretty healthy dead cats. Might be an ironic scenario, but that can happen where everything just feels beaten down. The market decides to jump a little bit of liquidity back in. Maybe some headlines turn around temporarily. And so you get just kind of full participation. Liquidity was sucking out. Liquidity comes back in and it looks healthy like it does today, but it doesn't mean a whole lot. That's why you kind of want to combine, at least in my view, you want to combine this sector rotation. How does this look? And then also the levels on the SPY. And those two things together can give you a pretty decent view. So for example, if all of those sectors, and especially technology, remains green all week, and we cross back over into the middle of this range, well, then I think we actually do look healthy, especially if the VIX is back down to 21 or 20 or 19, then okay, that looks healthy. Right now, we're still using this as resistance and not support. Okay, does everyone know what I mean when I say right now this still is showing up as resistance and not support, which is why we have to be very, very careful getting excited about the optimism right now in the market. Basically, we established a low below this level. We got a weekly close below this level, and we already had one test and a close below. So we have already established this, 670 range as resistance pushing lower and not a area where we're expecting price to shoot up. It's going to have to prove itself before we can feel optimistic about a move from the bottom of this zone back up to the top of the zone and not just bounces off the bottom to get further below, especially because this big 200 moving average is looming down here like a magnet, expecting that price is probably going to hit it at some point during this correction. Doesn't mean that's going to happen. We're in such a headline-driven market that obviously we could see the move right back up, but we're going to need more convincing than just, hey, we closed back above, so we're good to go. We're going to want to see participation across multiple sectors with a focus on technology outproducing, and we're going to want to see it show up here in the actual price action. Okay. Now, one of the things that we can look at, I use a data point called true momentum. And what you'll see if it'll take a second to load here is how many fewer stocks we have now than just a couple weeks ago when we were kind of at the top of this range. When we were at the top of this range, even though we were still net sideways, we had a lot of stocks that were kind of turning over, some industrial, some utilities, some basic materials that were turning over and getting very, very positive as we made this move. And what it looked like at the end of February is it looked like, yeah, technology is not going to be the strongest right now. It's not going to rip to all-time highs, but we've made a really nice rotation into some other names like industrials, utilities, and basic materials. And technology is not so weak that it's not going to pull us down. And therefore, things look like they might rip through 700 on the SPY. Well, what came next was, a turnaround in rotation and then more war news. And so, still loading. And so we now are not only at the bottom of this range, but actually got below the bottom of this range. And so not only has, the sector picture changed, but obviously the broad market picture is now very, very different than it was just 16 days ago, where it looked like, again, nothing confirmed, still totally sideways, but it looked like we had kind of completed a rotation that would usually mean a pullback, but didn't, and that was very net optimistic. Now, for those of you who are like, okay, you lost me, sideways, optimistic, down, what I don't know what's going on. You can go back and watch some of those replays because we talked about this in real time for months leading up to where we actually got a real correction headed to the downside. Jesus, it's taking forever. Our data is taking forever today, but I'll flip back and show you there if I can in a minute. But the point being, a lot less stocks now participating than just a couple weeks ago. All right, let's get into our lesson for today. I call this things you should know. And that's exactly what it is. It's, in my opinion, Things you should know, especially, again, if you're following me or Graham, or you just like the idea of trading more actively, or whatever the case may be. These are some of the things that I think are valuable and worth noting. And for some of these, it might be, hey, I need extra context before this even makes sense. That's fine. But if you are newer, which I know we had like 100 people say they're at least somewhat new, well, then take some notes on these. They'll make more sense to you as we go along, not just today, but in future days. And then also, it's a great time to show up early. Today's session is a 10-minute early session every day in front of Opening Playbook that he kind of walks you through how the platform works and some of the stuff that we do here in Opening Playbook. And it's a great forum to ask questions. He might not be able to answer all those questions in the 10 minutes he has, but he can send you video links and different things like that so that you can kind of get up to speed in the world that we live in. All right. So let's go ahead and jump in. Although, Dave, I saw you come on camera. Do you have something to jump in with before I get
I'm
rolling?
just going to mention there are a few people mentioning that the lotto board and a couple of things are kind of like not loading or loading slowly today. I think we are having like a data feed issue. So just give it a little bit of time. I know also lotto board, we generally don't use it first thing in the morning because it needs a little bit of data from the day to really do the analysis. So I would say just give it a few minutes to kind of work itself out.
Yeah, I'm wondering if the Polygon or something else is slow today, because I noticed that pretty much every tab on my dashboard is slow.
Yeah, exactly. But I did also, a couple of people were asking about where they can get some of the information you were just showing on the screen. I did just post in the chat there the link to the market maps. You can get those market maps delivered to you via Telegram for just $3 a month if you want to get some of the stuff that Nathan was just referencing delivered to you daily for $3 a month. The link is in the chat there for prosperitypub.com/map.
All right. Thank you, Dave. All right. So this is probably the number one question that I get, which is the debit spread versus credit spread, because so many people are very, very confused about debit spreads versus credit spreads, because they've heard things like credit spreads are for income and debit spreads are for trading direction. I'm sure some of you guys have heard it. Normally, when I ask, hey, has anyone ever heard our credit spreads for income and debit spreads are for direction, I get about 300 yeses in the chat that people have heard that. Well, the problem is that's not true at all. They actually function identically in terms of structure, risk to reward, time decay. All of those things actually function exactly the same. It's just a matter of doing it on the calls versus the puts. So, for example, if you did a bull call spread where you bought the 116 call and sold the 117 call, you could pay 85 cents for that, which means you're risking 85 cents to make the other 15 cents. That's what a $1 spread value gives you. It means if you pay 85, you have another 15 cents of profit potential. The scenario would be that if the stock is above 117, you win. If it's below 116, you lose, because that 117 is our line in the sand. Well, if you do that trade as a credit spread, the numbers are exactly the same. You collect the 15 cents of credit, that's your reward. You have the 85 cents of risk, that's the exact same risk that you have over here. And if the stock's above 117, you win. And if it's below 116, you lose. So debit spreads and credit spreads function identically in the market from a behavior standpoint. The curve of value and everything about them is the same. So why do I like debit spreads? Well, number one, it's just easier to understand and do the math for most people. And I do have a lot of beginners who I'm teaching spreads for the first time. And it's a little bit easier to show them, okay, you pay 50 cents, you sell it for 60 cents. Therefore, you made 10 cents against your 50 cents. That's a 20% ROI versus doing all that math backwards. So debit spreads, the math is extremely straightforward. And then also, it removes the risk of early assignment. So early assignment, for those of you who are newer to spreads, that's where the broker sends you one of these scary emails that says, hey, these shares have been assigned to you. And you think, oh my gosh, what do I do now? Well, in a credit spread, it's still not a big deal, but it usually means that you're going to take a full loss, because you then have to exercise the other side of your trade. That could be a full loss in the position. With a debit spread, it actually means that you make a net profit. I'll give you the example of that later. But the point is, you no longer have to fear an early assignment. It's actually a very big benefit to you with a debit spread. So those are the two reasons that I use debit spreads. Now, there is one benefit of credit spreads, which is that if you want the trade to expire, in other words, you're not going to manage it, you're just going to let it expire in your brokerage account, credit spreads become a little bit of a benefit because you don't have any assignment exercise fees at the end of the trade. They just expire. So no fees there at the end. So that is where a credit spread has a benefit. Now, one of the things that people really struggle with is the risk to reward on spreads. But it's actually very, very easy once you get the hang of it. Because once you understand the basics, the math is very, very clear. Unlike a call option or a calendar spread or something where you have to take into account implied volatility and all kinds of other factors to determine what is this actually going to be worth, a spread is very straightforward. The example is if you trade a 116, 117 spread like we just talked about, you know right away that your max value is $1 because that's the width of the spread. So from the moment you set up the trade, you know what the max value of that spread can be. If I trade a $5 spread, a 115, 120, I know right from the onset the max value of that trade is $5. If you trade a 740, 750, I know right away the max value is $10, right? So at the very beginning of a spread, you know the max value. Well, that's very important because then you know what your risk to reward is. If I'm paying 85 cents, I can't make 30 cents on the trade because the max value is only $1. I can't make 20 cents on the trade. I can only make 15 cents. That's what I can make. If I'm right and it finishes above 117, it will be worth $1 because I paid 85 cents. I know beyond a shadow of a doubt, I will make 15 cents of profit, which is equivalent to a 17.6% ROI. Now, the credit spread works exactly the same. It's just that the math is backwards. Okay, so you collect, quote unquote, collect the 15 cents. If it goes down, you're going to lose it. And so you're going to lose the same amount. If it goes up, then you're going to get the value of it and you're going to make the full 15 cents, which is also a 17.6% ROI. So they work exactly the same. It's just the math is done backwards. But again, with a spread, one of the big benefits is that you know the values going in and you always know your risk and reward from the beginning of the trade. If you guys are newer and you're still not quite sure how this all works out, I have that How to Trade Debit Spreads class. It's over an hour long that just takes you step by step by step through this spread process. And I think once you kind of go through that and do a couple trades live with us and drink out of the fire hydrant for a week or two, you'll get very comfortable with all of this kind of language and structure, and it'll make a lot more sense to you. Now, one of the things that people often forget about spreads, because we think of it as a line in the sand, which is a terminology that I use all the time, is that you do have this middle zone here. Okay. So we think of spreads as a binary trade because that's kind of the easiest and most simple way to look at it. If it's above the level, I win. If it's below the level, I lose. But we do have to remember that there is an in-between on a credit spread or a debit spread. And the in-between is the prices between the two strikes. So again, if I bought the 683 and I sold the 684, the in-between is that $1 range. But if I bought the 680 and sold the 690, well, now that in-between is $10 wide. So it's just the strikes that you bought and sold. And the level in between is this partial value. Now, the reason it's partial value is because one leg is going to be in the money and one leg is going to be out of the money. Let me ask in the chat, does everyone know what in the money and out of the money is? Give me a yes or a no. Totally fine. If you don't, we can pause for a second. If you know what in the money and out of the money is, but that's what's going to dictate this partial value. Now, we always know that below on a bullish spread is just zero value. We just lose whatever we paid. Very simple. If I paid $90, I lose $90. If I paid $50, I lose $50. Okay. Period. End of story. If it's below that level, I lose. On the flip side, if it's above that level and expires, it's worth the total value of the spread. Again, $1 spread means it's worth $1. A $5 spread means it's worth $5. So how do you know how much money you made? Well, if it's worth $1, and we know that for sure, which it is, we just subtract what we paid for it. If I paid 50 cents, I made 50 cents. If I paid 60 cents, I made 40 cents. If I paid 70 cents, I made 30 cents. It's just math once you get the hang of understanding the value structures here on these spreads. Okay, so this is a bullish example, obviously, where below 683 means losing money, above 684 means making money, and then you'll have some partial value in the middle where we always recommend you close the trade toward expiration. Because again, there's that in the money versus out of the money. We'll talk about that here in a second. I got at least one no, by the way.
What it meant.
Sorry, go ahead, Dave.
We did have a couple people say they weren't sure what it meant.
Yeah, I got at least one no I saw in there, or a couple. So in the money means that your option, it has intrinsic value and is in danger of being exercised. So the very simple way to think about it is on a call, on a long call, in the money is anything above that. On a short call, it's anything below that. On a long put, it's anything below that. And on a short put, it's anything above that. It's where it has value. So if you just think about, okay, I bought a 180 call on Apple and Apple's at 181, that's in the money. It has value now, intrinsic value, because it's above that level. Versus if I buy a 180 call on Apple and Apple's sitting at 165, $15 below that, clearly that call has no intrinsic value, right? So that's the in the money versus the out of the money. And I'll give you an example of where you're in between, what that matters. No, I don't always recommend closing with partial value. I only recommend closing with partial value if you're in between strikes. So two very different scenarios. If you're way above 684, you don't do anything because you're going to get full value. Now, some strategies use a target, but generally speaking, I'm not worried about closing it. It's when you're in between that you always want to close it because you don't want to open yourself up to the assignment there. And I'll go through that example shortly.
Yeah, well, they said partial value. So it wouldn't be, if you were way above, it wouldn't be partial value.
Well, it would be partial value before it expired, technically. Partial value might be 99 cents out of $1.
So, yeah, it's at expiration, right? I think the key thing is it's at expiration.
Yeah.
You want to close it if it's at expiration in partial value.
And again, I'll walk through that in another one of these questions. You can let me know if it fully makes sense. If not, we can go back through it. Okay, here's the big question I always get as soon as we talk about spreads. Nate, I heard some experts say that if you trade a spread, you're going to get early assigned. You'll go bankrupt. Your family will be on the streets for the rest of their lives as soon as you trade a spread. Okay, the answer is no. If you trade a debit spread and you get assigned early, keyword here, early, that means before expiration, that is your best case scenario on a debit spread. Here's the example. I buy a $77 call on Wells Fargo. I sell a $79 call. Typical $2 wide debit spread. For some reason or another, halfway through the trade, we get a very scary email from our broker saying, uh-oh, you're now forced to sell 1,000 shares. That would mean that you bought 10 contracts. You're forced to sell 1,000 shares of Wells Fargo. You only have $8,000 in your account. Again, your life is over. But what you have to understand is that you still own the $77 call. So the assignment has to do with the $79 call. That's the only one that you can be assigned on. You have 1,000 shares because of that option, but you still own the $77. Now, what is the $77 call in practice? Well, it's giving you the right to buy shares at $77 on Wells Fargo. So when you actually do the math, it means that, okay, someone just forced me to sell shares at 79. Well, I'm going to buy them at 77 by exercising this option. I'm going to sell them at 79. And it doesn't take a rocket scientist to know that if at the same time I buy shares at 77 and I sell those same shares back at 79, I just made $2. Well, $2 is the max value of the spread. That's actually where the max value comes from. It comes from this scenario, that it's the difference between those two strikes. Now, for some of you, that's still a little bit out in the weeds because you don't exercise an assignment is not even familiar to you. But the important thing I want you to take home, at least kind of in phase one, is that when you trade debit spreads, this is not actually a risk to you. Might be confusing. You might have to call your broker, but it's not a risk to you. It's a very, very good thing all the time in those scenarios. Now, when it comes to expiration, like Dave and I were just talking about, it changes a little bit because you don't want to get assigned on half of your trade. But if it's an early assignment, it's always a good thing. And if anyone tells you that as soon as you get assigned, your life is over, just understand it's always a simple, basic math question. All right, now here's the one that is a little bit more nuanced. What if a spread expires between strikes? Expires means it ends up on the expiration date. Okay, so the example here would be I have a $49, $50 call spread on XLF for a January 16th expiration. And on January 16th at 4 p.m. at the closing bell, it's between these two strikes. It's between $49 and $49.99. Well, what that means is that the $49 trade is in the money, but the 50 is not, right? So this one is in the money, but I don't have the right to sell it at 50 anymore because it actually expired below 50. Again, if you're new, don't worry. These are some terms, expiring, in the money. I get it. But just for now, you don't want it to expire in between here because it means that you'll get shares without the right to sell those shares right away, like we do in the early assignment example where both options are still active. Okay, so you would own shares at 49, but not have the right to sell shares at 50. This is what matters. Now, that could be a good thing, but it's just you're just playing with the luck of the draw at that point, right? You get shares assigned you at 49.50 or at 49, and it's at 49.50. Well, that means you have 50 cents of value, but you can't really do anything until the next Monday when the market opens up, and it's a crapshoot. If it's up, you'll be happy that you accidentally got assigned. If it's down, you'll be very upset. The point that I want to make is that this is very easy to avoid. Don't even mess with it. Just don't even mess with this. Check your trade between 3 and 4 p.m. on expiration date. If it's close to those strike prices, just exit. Just exit the trade. Usually you're going to be around break even because it's in between. Might be a little bit of a gain, might be a little bit of a loss. It just depends on where at within those two strikes it is, but it's easy to avoid. One thing to note is that if you already have an existing limit order, that means you already have a closing order working for that position, you'll have to cancel that and replace it to get out. But that's, again, very easy, 2 clicks. If you look at your trade between 3 and 4 p.m. and you're worried about it expiring between those two strikes, just call your broker. Hey, I have this position. I'm worried about it. Can you help me close it? Simple, easy. They will help you. And then you don't have to worry about the dreaded assignment. If it's XSP or SPX, then you don't do anything. Just let it go. No worries whatsoever. Those don't have any exercise risk at all. Now, here's another question that I get all the time, which is how much should you chase a spread? Hey, Nate, I got the alert. It was at 113. Now it's 116. What should I do? Well, the issue with chasing a spread specifically is that we talked about that capped reward, right? So a $1 spread could only ever be worth $1. A $5 spread could only ever be worth $5. So as soon as you start paying more, you're really hurting the ROI potential on the other side. Here's an example with a XLF 49.50 call spread. If I pay 46 cents for that spread, I have the potential to make 117%. If I pay 2 pennies more, it's almost 10% less. 3 pennies more, I'm making less than 100%. 10 pennies more, I'm only making 78 cents. So do you guys see how on a $1 spread, a change in 10 cents, paying 46 versus 56, takes it from a 117% ROI down to a 78% ROI. That is a dramatic shift down for only 10 cents more of cost. And that's really why we have to be careful about chasing prices too much. My rule of thumb is not to pay more than about 5% of that recommended price. That means on a $1 spread, you're probably going to chase it about 2 pennies at the most. On a $5 spread, okay, now you can chase it maybe 10 pennies, right? So 5% would be a general rule of thumb because you really don't want to kill your ROI potential. We often talk about positive expectancy. Well, if I have a trade that I think is a coin flip, a 50-50 chance of winning, and it can make 117%, we would consider that a positive expectancy. But if I pay too much for it and has a 78% ROI, now it's a negative expectancy. We literally went from a good trade to a bad trade by paying 10 more cents. All right, so that's why we have to be very careful about chasing price. Another very common question is, does volume and open interest matter? Because again, I hear people say all the time, make sure it has tons of volume, make sure there's open interest on it. I'm a little bit different. I don't really care that much. And I say usually, I mean, the word usually is important. Sometimes it does matter, but usually I don't care a whole lot because my rule is that I only ever pay what I want to pay for a trade, right? So if I like a trade that I think has 100% ROI potential that I can spend 50 cents on, and someone says, oh, well, hey, that's low open interest, there's low volume, you don't want to trade that. Well, my thought is, well, if I can get it for 50 cents, I want to trade it, right? So if I can pay what I want for it, then I do want it. If not, then oh well. So in my opinion, I'm a little bit against the grain here. I don't really care if a stock or an option has relatively low volume as long as I can trade it for the price that I want. Low volume, widespread, just make sure you're using a limit order. You should use a limit order anyway. Only pay the price you want. About 75% of the time, you'll feel fine, even if it's a low volume. The other 25%, don't chase it. It's fine. You missed that trade. No big deal. Don't force anything. Move on to the next trade. One thing to note, volume does become a lot more important if you plan to use targets, because then you want it to exit more easily. And so if you want to get an exit more easily, then that volume and open interest does help a lot, because at more transactions, your target is going to be easier to fill. Okay? So just note that if you're using a target, volume becomes more important. Here's one of the funny things about the stock market. Are spreads more expensive on good stocks than bad stocks? The answer is no, they're actually not. It's one of the more surprising anomalies in the stock market, because you would expect, hey, a good stock has a higher chance of going up. Therefore, the spread value is going to be automatically adjusted higher, which it is on something like the SPY and the Qs, but it's not on something like Apple or Nvidia. So in reality, even though basic calls are typically going to be more expensive for good stocks, they're going to have a higher skew, we call it, right? So we would call that a skew to the upside. Nvidia has a bullish skew, therefore the options are more expensive to buy on calls versus puts. But when you do a spread, you're taking out that skew because you're buying the call and selling the call at the same time. Therefore, they don't have that, skew that's working against you for a good stock. Here's one that I get a lot of questions. I've done a couple different lessons on it, which is, how do I manage a discretionary trade, right? Because for me, most of my strategies are mechanical. I already have a target going in, or I already know that I'm going to let it expire going in. So I don't really have to worry about managing it. But then I have a handful of discretionary trades, and People say, well, how do you manage those? So I use what I call a time versus ROI analysis. What that means is that when I set up a trade to begin with, it has a certain amount of potential value and a certain timeline that it has to generate that value. Every option trade has that. You might not think about it in those terms, but that's exactly what it has. If I buy a spread for 50 cents that could be worth $1 for next week's expiration, well, that would mean that in 7 days, it has the potential to return 100% of whatever I invested, right? So think about it like this. Let's say I spent 50 cents or $50 a contract times 10 contracts. I have $500 of risk over the next 7 days. I'm planning on that doubling because I paid 50 cents and it could be worth another 50 cents, which means over 7 days, I want to make $500. And that's how everything would work, just with different numbers. Well, now we know that my time to ROI potential is that I'm trying to trade 7 days of time for $500 of reward. That's the trade-off I'm trying to make. And once you know that, you can manage it on a time versus ROI basis. All right, so let me ask you in the chat. If I'm planning on making $500 over 7 days, which would be, like $80 a day or $75 a day, and on day 2, I'm up $380, should I close the trade? If I was originally planning on making $500 over 7 days, and now I've made $380 over 2 days, should I close the trade? Well, most of you would say yes, and I would as well. Because to me, I'm way outpacing my time versus ROI. Now, most people don't think in those terms, but you guys, as soon as I put it in those terms, all answered correctly that yes, you should close the trade. Well, there you go. That's how I would manage it. Just do that math on your trades. Put it in those terms, and you have a much clearer answer of whether you should close the trade. Instead of making a gut feeling, make it a math decision. If it's somewhere on the regular pace, I've made $120 over the first 2 days, then I would hold it. If I'm way, way above the pace, I would close it. I use a rule of thumb about 3 times. If I'm 3 times the pace that I expected on the time versus ROI, go ahead and close the trade. Whole bunch of questions about this all the time because I use lots of targets, but I also let certain trades go to expiration. Which one is better? What are the trade-offs? Well, if you use a target, you're going to have a higher win rate. If you go for the max net ROI, typically letting it expire is going to beat that. Not all the time, but often. Your open risk is always going to be higher if you let it expire. And the reason for that is because you're stretching out your time horizon, and therefore you have the ability to have more open trades, which is exactly what this last bullet is saying. Shorter hold times versus longer hold times. A lot of people don't realize that longer hold times directly impact your max open risk. Because if I take 1 trade a week or 2 trades a week or 20 trades a week, doesn't matter. Net, if I have longer hold times, I'm going to have more open positions at any given time. So those are the trade-offs to consider on using a target versus letting a trade expire for max value. Do I ever adjust my limit order? Yes. There's one scenario where I do this, which is that when the market is set to open with a big gap in my favor, I want to cancel the existing good till canceled order, and then I want to wait for the market to open and close with a new limit order to capture more profit. Okay, so this would be the situation that I was planning on making 30% ROI, but the market's going to gap open and I could make 80% ROI instead of 30% or even 50% instead of 30%. Well, then I'm going to cancel that order and I'm going to go ahead and manage it after it opens, going for that bigger profit. Now, please note, you actually can get filled more than your limit order. A lot of people don't know this. if I trade a spread and I set a limit order for 80 cents and the market gaps up, I can actually get filled for more than 80 cents with that order. The problem is I'm going to get kind of the worst price possible. It might be 84 cents and it could have been 90 cents. Okay. So this is the one situation where I canceled the working order and I update it after the market opens. All right. And then just kind of a summary of things to remember here as we go through today. Let's see if I can post those in the chat. There you go. Summary of kind of things to remember. If a $1 spread can be closed for 98 cents weeks before expiration, close it. It's not worth holding on, both from a buying power and a net ROI to time ratio. Check with your broker on your assignment fees, because you might decide you never want to let anything expire if the fees are high. If you want to hold most trades to expiration, then maybe you should consider trading or switching to credit spreads, because credit spreads will give you an advantage with no extra fees. If you want to trade the SPY, you can use SPX or XSP. Then you don't have to worry about expiration. Just settles in cash. In other words, there's no shares to assign, so you don't have to worry about that. Don't chase entries. That's a big one. A 5% overpay can cut your ROI by 30%. Always use limit orders. Whether you get filled or not, only chase so far. And then remember, the width of the spread is always the value, the max value, period. Any other way you slice your risk reward is going to be done with the width of the spread math. Okay, I'm going to switch gears pretty heavily here because we're opening our other Zoom room where I'm going to go through a handful of stocks. I'm calling it buy this, sell that. Basically, kind of three what I would consider more undercover stocks, ones you won't usually hear me talk about that I think are long-term opportunities. I have some research that I put together on each of those stocks, and I'll share that. So that Zoom room is open. If you guys want to move over there, I'm going to move over there in just a minute after I scan through these questions real quick.
Yeah, the link is at the top of the chat for that 11 a.m. and it's also in the announcements. I've been answering a bunch of the questions in the chat. One that I kind of left for you was regarding assignments on puts as to calls.
Same exact structure for puts versus calls. It's just going to be that your long put is assigned, which is the same as your short call being signed, or your short put is going to be assigned, which is the same as your long call being signed. So the direction flips, but the assignment works exactly the same way. If I have one short put at $78, that means a sold put at $78, and it expires in the money, well, then I'm going to be assigned that, $78 put, or sorry, I should say if it expires below that put, I'm going to be assigned. And then with a credit spread, if it's above both, because they're puts, that means above is out of the money, right? So if they're above on a put, that's out of the money, that's why credit spreads are confusing, because you want it to go out of the money. You want it to expire worthless. A put below is going to be in the money, above is going to be out of the money.
We also had 100 questions about getting the slide deck or watching this again. I've posted a few times, but I just posted again. Replays and the slide deck are available in our $1 members area. You can get the replays without the $1 members area, but if you want the slide deck as well, be able to copy and paste from it and stuff, grab that link there. The $1 opening playbook membership is the best dollar you'll ever spend. There is a ton of stuff in there for $1, and you get forever access. It's not just one-time access for $1. I can stick around and maybe answer any follow-up questions that I'm able to answer if you need to jump, Nate. I don't want you to be late for the other meeting.
Yes, I will do that. Mitch, it is based on the target, the win rate because I always use a target on every single trade. So I don't even keep the data on the expiration. I do have the original testing from the full expiration, but I don't even keep the data.
I even answered that already, Mitch, if you look in the chat, but that's okay.
Oh, wow.
That's
the
right. They want to hear from
Dave
you,
today.
not from me. I understand. I want to hear from you, not from me too.
All right, guys.
But we do. It's also based though on letting when you don't hit the target, it's based on letting it holding it till expiration and not closing it early. We don't close the losses early to give it a chance to hit target. So in a sense, we're holding it till expiration. We're never using a stop loss, but
That's
we're
true.
we're, we're always setting a good till cancel target.
True, true, true. Okay, guys, I'm jumping over to the Zoom room. If you want to get my 3 stocks, I will see you there in approximately 2.5 minutes, 3.5 minutes. Well, hopefully they're early because being early is good. But I'm jumping over there right now. See y'all.
All right. Thanks, Mitch. Thanks, Don. I'll hang out a couple of minutes here. Uh, Henry, you said you missed the Zoom last night. Where can you see it? You're talking about Alex's, Henry? You're talking about Alex's Zoom last night? Yeah, I'll give you the link. 1 second. Here's a replay of Alex's Sunday night. All righty. Any questions that you feel like we missed, guys, that I can try and answer for you? If you posted it and you didn't get an answer, I apologize. We do try and get to as many of them as we can, but there's obviously a lot going on, and Nathan wants to get through his prepared materials primarily, and then get to as many questions as we can. Sandra says, would an OCO order be a good strategy for above or below? So an OCO, or one cancels the other, is usually when you are setting a stop loss as well as a profit target. So Nathan almost never uses a stop loss when it comes to spreads. His general, methodology with spreads is that you design the spread. One of the reasons to use a spread instead of just buying a call or buying a put is that the spread reduces your risk because you're selling against the cost of what you're buying. So the spread reduces your risk, and you use that to control your risk, but then basically put into that spread, risk or spend however much you're willing to risk on the trade, and not use a stop loss. So Nathan will almost never use a stop loss. On the other hand, there are strategies that are proven to work with stop losses. Like Kane has a strategy where he uses stop losses in his spreads, but again, doesn't do it all the time. So an OCO is good if you're going to set both a profit target and a stop loss. I mean, that's basically what it is. You're kind of setting two potential exits, one up, one down. And then the OCO means one cancels the other. Obviously, if it hits the top target, you're going to cancel your bottom order. If it hits the bottom target, you're going to cancel your top order. But only if you want to set a stop loss. Nathan doesn't generally set stop losses. Yes, Mitch, Alex's promo was to become a diamond member of his club and also get early access to his Night Rider program, which is only available right now to diamond members. And give me 1 second here. I see Nathan's joining the other room. Let me get that ready for him. Hey, Nate, you want to grab it now? All right. Hopefully, you're all moving over to that other room with Nate, and we're going to close this out here now. Um, the link for the other call is not working. It should be. Let me give you an alternative link to that other call so you can get in there. Hold on a second. Try this for that other call. Anybody else have anything else before we close out this session? All right. Use one of those two links to jump over to the 11 o'clock with Nate. We'll see you there.